Hey ladies and gentlemen, welcome back to the channel. I'm John Smith, and if you've been watching the silver market over the past few weeks, you probably felt something strange in the air. Maybe you were excited, maybe you were nervous, maybe you refreshed your portfolio app more times than you'd like to admit. Because silver, this metal that most people barely think about, did something remarkable. It ran up fast. It pushed towards $78 per ounce, a level that hadn't been touched in decades. And then, just as suddenly, it pulled back hard. And now the question burning through every investor forum, every finance subreddit, every trading Discord is this: was that a genuine collapse? Or was it a trap set by the big players to shake out smaller investors before the next leg up? That is exactly what we're going to break down today. And I want to be clear from the start. This video is not about telling you to buy or sell anything. I'm not a financial advisor, and nothing here is financial advice. What this is a clear, honest breakdown of what happened, who the major players are, what the data says, and how you, as an everyday investor, can think about this situation with clarity instead of panic or euphoria. So if that sounds useful, stick around, because we're going layer by layer through this entire story. Let's start at the very beginning, because before you can understand why $78 matters, you need to understand why silver is interesting right now. Silver is not just jewelry. It is not just coins at a pawn shop. Silver is an industrial metal, a monetary metal, and increasingly a critical component of the clean energy revolution. Solar panels need silver. Electric vehicles need silver. Semiconductors need silver. Medical devices need silver. So unlike gold, which is primarily a store of value and a fear hedge, silver has a dual identity. It behaves like a precious metal when people are scared about inflation or economic instability, but it also behaves like an industrial commodity when manufacturing and technology demand kicks in. That dual identity is what makes silver one of the most volatile and fascinating metals in the world. It can surge on fear, and it can surge on economic growth. Right now, we are living in a moment where both of those forces are pushing in the same direction. Inflation concerns have not gone away. Geopolitical tension is real. And at the same time, the global push for renewable energy means industrial demand for silver is projected to climb significantly over the coming decade. That combination created a powder keg, and in recent weeks, that powder keg got lit. So let's talk about the run-up. Silver was trading in a relatively calm range for a while, hovering in the mid-20s to low 30s per ounce. Then something shifted. Money started flowing in, momentum built. Retail investors got excited. Institutional money started moving too. The price climbed through 30, through 35, through 40, and eventually made that dramatic push towards $78 per ounce. A price not seen since the legendary silver squeeze of 1980, when the Hunt brothers famously tried to corner the market. The psychological and technical significance of that range is undeniable. It was a moment that made even longtime market watchers stop and stare. And then the rejection happened. Price hit that zone and came down, hard. Within days, silver gave back a significant portion of its gains. And that is where the story gets really interesting, because depending on who you talk to, that rejection means completely different things. Some people said the bubble popped and silver is going back to 25. Other people said that was a classic institutional shakeout and the real move is still coming. So let's look at this from multiple angles, rather than just picking a side. First, let's understand what a price rejection actually means in technical terms. When a price approaches a historically significant level, the market tests it. If buyers are stronger than sellers at that level, the price breaks through and establishes a new range. If sellers are stronger, the price gets pushed back down. That is called a rejection. At $78, you have one of the most significant resistance levels in silver's entire recorded history. It would actually be strange if the price just sailed through without any fight at all. So the rejection itself is not automatically bearish. What matters is the quality of the rejection, what happened in the order flow, what the futures market showed, and what happened in the aftermath. A rejection at a major resistance level can mean three different things. 1. The rally is over and price will return to a much lower base. 2. The price is consolidating before making another attempt at that level. Or 3. And this is the one that gets talked about most in trading circles. It was a deliberate institutional move designed to shake out weak hands before the real move higher. Let's walk through all three scenarios honestly. The bearish case deserves a fair hearing first. Silver has had dramatic run-ups before that ended in painful crashes. The 1980 spike to nearly $50 was followed by a collapse that took silver below $5 over the following years. The 2011 rally to almost $50 ended with a reversal that took silver back to the teens. History shows silver is not immune to speculative excess. When retail enthusiasm gets ahead of fundamentals, corrections can be severe. Some analysts are pointing out that the recent rally had characteristics of speculative momentum. Options activity was elevated, social media buzz was loud, and whenever those conditions exist, the potential for a sharp reversal is real. That said, even in the bearish scenario, few serious analysts are predicting silver goes back to $20 and stays there. The underlying demand picture from the industrial side is too strong. The silver deficit, meaning the gap between how much silver is mined and how much is consumed, has been widening for multiple consecutive years. That structural dynamic does not disappear just because a speculative trade unwinds. So the bearish case is more of a price needs to cool off story than a silver is going back to its lows story. Now let's talk about the institutional shakeout thesis, because this is the one generating the most discussion, and it deserves a careful explanation. Large institutional players, hedge funds, commodity trading advisors, big banks, operate at a scale fundamentally different from retail investors. When a retail investor buys 1,000 ounces of silver, it barely registers. When a major commodity fund repositions hundreds of millions of dollars in silver futures, it moves the market. And these institutions understand something most retail investors do not fully appreciate. The market is not a neutral mechanism. It is, to a significant degree, a machine that transfers money from the impatient and emotionally reactive to the patient and strategically positioned. Think about it this way. Imagine you are a large institutional player who wants to accumulate a big silver position because you believe the price is going higher over the next 12 to 18 months. If you just buy everything you want at current prices, the act of buying pushes the price up before you have finished building your position. That is not ideal. So what sophisticated traders sometimes do is engineer a sharp drop that triggers fear and forced selling from other participants, then absorb that selling pressure and accumulate at lower prices. This is sometimes called a shakeout, a stop hunt, or a liquidity grab. It is not a conspiracy theory. It is a well-documented pattern in financial markets, studied by academics and practitioners alike. The signature of an institutional shakeout often includes a few telltale signs. You see a sharp, fast move down that goes just far enough to trigger stop-loss orders from retail traders and force margin calls from leveraged positions. Then the selling pressure dries up quickly. Volume tells an interesting story. High volume during the sharp drop, which reflects forced selling being absorbed by buyers, then volume stabilizes, and the price recovers relatively quickly, often with no change in the underlying fundamental picture. In certain respects, that pattern is consistent with what happened in silver recently. The speed of the reversal was dramatic. The recovery afterward was faster than you would expect if this were a genuine trend reversal. But I want to be really careful here, because this is where a lot of finance content goes wrong. Just because a move looks like an institutional shakeout does not mean it definitely was one. Pattern matching in financial markets is notoriously tricky. Humans are wired to find patterns, and we can see patterns that are not really there. We cannot know with certainty what the dominant force behind any given market move was. Anyone who claims they know exactly what institutions are doing is either guessing or exaggerating their insight. What we can do is look at the surrounding evidence and make a probabilistic assessment. And here's where things get genuinely interesting. The Commitment of Traders report, published weekly by the CFTC, gives us a window into how different categories of market participants are positioned in COMEX silver futures. When you look at recent COT data, the positioning tells an interesting story. Commercial hedgers had been reducing their net short positions ahead of the recent rally. That is a moderately bullish signal because commercial hedgers typically short silver to hedge physical holdings, and when they reduce that hedge, it sometimes suggests they expect prices to move higher. Meanwhile, large speculators, which include many hedge funds, had built up significant long positions during the run-up. What often happens in these situations is that the large speculative longs are vulnerable to a sharp reversal. They are using leverage. They have stop-loss orders at certain levels. If price dips hard enough, those stops get triggered. The forced selling creates more downward momentum, which triggers more stops, and you get a waterfall effect. This waterfall of forced selling is what creates a shakeout that looks more dramatic than the fundamental situation warrants. Market makers and well-capitalized institutions on the other side absorb the selling and end up with larger positions at lower prices. The circumstantial evidence here is consistent with that interpretation, even if we cannot confirm it with absolute certainty. Now, if you are still watching, a quick thank you. If this kind of calm, honest market breakdown is useful to you, the like button helps this channel reach more people looking for rational financial content rather than hype. And if you have not subscribed yet, consider it. Okay, back to the analysis. Let's talk about a variable that does not get discussed enough, the dollar. Silver is priced in US dollars, which means dollar strength or weakness has a direct mechanical effect on silver prices. When the dollar strengthens, silver faces headwinds because it becomes more expensive for international buyers. When the dollar weakens, silver gets a tailwind. Over the past couple of years, the dollar has been at historically elevated levels, which has acted as a significant brake on silver's price appreciation. If the dollar were to weaken meaningfully, perhaps from aggressive Federal Reserve rate cuts or eroding global confidence in the dollar, that headwind could become a powerful tailwind. I am not predicting that. Currency movements are notoriously hard to predict. But it is a crucial variable to understand because it helps explain why silver has not already moved even higher, given the fundamental backdrop. Let's also look at the gold-to-silver ratio, because this is one of the most useful analytical tools when thinking about silver's valuation. The ratio measures how many ounces of silver you need to buy 1 ounce of gold. Historically, this ratio has averaged in the range of 15 to 50 over very long time periods. At various points in recent years, the ratio has been above 80, even touching 90, which, by historical standards, indicates silver is significantly undervalued relative to gold. Here is what makes this interesting. If gold maintains its elevated price levels, then for the ratio to normalize toward historical averages, silver would need to move substantially higher. Some analysts use this framework to argue that silver has significant upside potential just from mean reversion in the ratio, independent of any absolute price target for either metal. It is a relative value argument and one of the more intellectually honest frameworks in the precious metals space. Now let's address the manipulation question, because it comes up in every silver discussion. The claim is that major financial institutions actively intervene in the paper silver market to keep prices suppressed, because rising precious metal prices signal distrust in fiat currency. This is not pure fantasy. Documented cases of manipulation in precious metals markets do exist. Real regulatory investigations have produced real findings. However, even if some degree of price management exists, markets are too large and too global for any single actor to permanently suppress prices against powerful fundamental trends. The responsible approach is to acknowledge that manipulation is real and documented at certain times, while not letting it become your entire framework. When everything gets blamed on manipulation, you lose the ability to think clearly about the many other legitimate forces that also shape prices. Now let's think through the possible futures for silver in a genuinely balanced way. The first scenario, what I would call the fundamental bull case, is that the recent rejection was a normal test of major resistance the market consolidates, and then fundamental demand from industrial and monetary buyers eventually pushes silver to new highs over the coming years. In this scenario, investors shaken out by the volatility miss a significant portion of the gains. The second scenario is a prolonged consolidation. Silver has gotten ahead of itself in the short term, needs to work off the speculative excess, and enters a period of sideways to modestly lower prices for 6 to 18 months before any renewed uptrend. This would be frustrating for investors who bought near the highs but would not negate the long-term thesis. Markets often need to breathe after strong moves. The third scenario is a more significant correction, where macro conditions shift enough, a stronger dollar, rising real interest rates, or a severe global recession, that silver falls back to the $25 to $30 range or lower. This would be painful for silver bulls, but could represent an opportunity for long-term investors to accumulate at lower prices if the fundamental thesis remains intact. The fourth scenario, the most extreme, is a silver supercycle driven by industrial demand, monetary demand, and weakening confidence in fiat currencies globally. Some bullish analysts have made cases for silver reaching triple digits in this kind of environment. I present it not to generate excitement, but because intellectual honesty requires acknowledging the full range of possibilities. Nobody knows which scenario plays out. Anyone claiming certainty about where silver is going is either confused or misleading you. What you can do is understand the framework, understand the key variables, and make your own decisions based on your personal financial situation. Here is something deeply underappreciated in these conversations. How you own silver matters as much as whether you own it. There is a significant difference between physical silver, a silver ETF, silver mining stocks, and silver futures. Each carries different risks and suits different investors. Physical silver gives you actual possession of the metal, valuable in extreme scenarios, but involves storage costs, insurance, and meaningful bid-ask spreads. Silver ETFs offer easy price exposure without storage hassle, but involve counterparty risk and management fees. Silver mining stocks offer leveraged exposure, meaning they move more dramatically in both directions, but carry company-specific risk. A poorly managed mine or geological surprise can devastate a stock even if silver is rising. Silver futures are powerful for sophisticated traders, but generally inappropriate for everyday investors, given the leverage and complexity involved. The how genuinely matters. Let me tie everything together. Silver approached $78, a level of enormous historical significance, and was rejected sharply. The question was whether that rejection represents a trend reversal, a normal consolidation, or an institutional shakeout designed to clear weak hands before the uptrend resumes. We looked at historical precedents, technical patterns, COT positioning, the fundamental supply-demand picture, the dollar dynamic, and the gold-to-silver ratio. None of these alone gives a definitive answer. Together, they paint a picture that is complex, genuinely uncertain, and requires intellectual humility. What is clear is that the fundamental story for silver over the medium to long term remains intact and is arguably stronger than it has been in years. Industrial demand is rising structurally. Supply growth is constrained. The monetary dimension is being reawakened by inflation concerns that have not fully resolved. What is equally clear is that the short-term path is noisy and unpredictable. The $78 level will remain a major battleground, and how the market behaves there in coming months will tell us a great deal about whether the bull case is gathering durable momentum or needs more time. For everyday investors, the most useful mental model is this. If you believe in the long-term case for silver based on fundamentals, short-term volatility is not your enemy. It is the price you pay for the potential return. The investors who regret the $78 rejection most are not the ones who held thoughtful positions through the volatility. It is the ones who bought impulsively near the highs, driven by FOMO, panicked when price dropped, sold at a loss, and then watched price recover. That emotional cycle is exactly what markets are designed to exploit, especially in metals. If you are wondering whether to start any silver exposure, The question is not whether now is the perfect entry point. You will never find that. Ask yourself whether the long-term thesis makes sense for your financial picture, whether your time horizon is right, and whether you are starting small enough that volatility will not force emotional decisions. These are personal questions only you can answer, ideally with a qualified financial professional who knows your full situation. The noise will always be loud. Headlines will always feel urgent. Social media will always be extreme in both directions. The investors who do best over the long run are rarely those with the best predictions. They are the ones with the clearest thinking, the most honest assessment of uncertainty, and the discipline to act without being whipsawed by daily drama. Thank you for watching all the way through. If you have questions about anything we covered, drop them in the comments. I read them and engage as much as I can. If you found this valuable, sharing it with someone interested in silver or precious metals would be a huge help to the channel. I'm John Smith, and I will see you in the next one.